Thank you, John, and thank you to everybody. It's been a great 3 days, well, 2 days, and just about to kick off the last day with some really transformative conversations about a lot of exciting things happening here in the region and around the world. And that's what we're talking about today, is the potential impact for some of these amazing projects, investments that are taking place. We're talking about investing for global impact. Now, minimizing the negative societal consequences of an investment is no longer nice or some kind of philanthropic PR move. Investors today are increasingly prioritizing positive and measurable environmental governance or social outcomes alongside financial gains. And global impact investing has shown significant momentum despite disruptions caused by the pandemic, topping now $1 trillion for the first time last year. And some investors have been making impact investments for years, but recently there's emerged this new global international collaborative effort to accelerate the development of a high-functioning market that supports impact investing. And it's a significant milestone, this $1 trillion, but it's also a call for further action, because to achieve the UN Sustainable Development Goals by 2030, to reach net zero emissions by 2050, there's an estimated $4.2 trillion funding gap. And there are questions about the balance between financial return and social valuation, and that's prompted calls for adequate metrics to ascertain whether these investments are truly helping humanity. And so I can't think of a better panel to be talking about this with me today. Brian Hook is the vice chairman of the Cerebus Global Investments, and one of the architects of the Abraham Accords that we've been talking about a lot this week. Jenny Lee is the managing partner of GGV Capital, among other things. Jacques-Philippe Piverger is the CEO of Good Light Capital, and Rodrigo Tavares is the founder and CEO of Granido Group. Thank you all so much for joining us. Jacques-Philippe, let's start with you. Now, impacting and sustainability is really at the heart of Good Light's mission. So, when it comes to social impact investing, let's talk a little bit about what the investors need to consider and do in order to really ensure that positive impact.
Sure. Thank you, Elise. And I just want to first thank the organizers of FII. This has been amazing. I came to the first one 5 years ago, and to see the progress over this period of time has just been outstanding. And I just want to make sure I say thank you and how much we appreciate the work that's gone into it. With respect to impact investing, I think what we'll hopefully triangulate on here in this conversation is that there's a high correlation between purpose and high returns in investments and in terms of mitigating risk. And if you look at the last couple years where there are significant dislocations related to the economy, if you're simply investing in companies that are bottom line driven and they're not solving for things that are of consequence, they're going to be more exposed to risks and challenges, and they're not particularly important in many ways. So for example, on our end, we specifically target companies related to climate, health, education, future employment, fintech. And what we've seen in our portfolio is continued high performance irrespective of what's happening, because unfortunately, right, wildfires are still happening. So if you're investing in a high growth tech company that's solving for that, it's not likely to do as poorly, or health, right, around cancer or things of that sort. So what I would say there is investors should really start to think of impact as something that correlates highly with performance as opposed to something that might be concessionary. Have a lot more to say, but have a lot of respect for our fellow panelists. I'll pass the mic. Thank you, Elise.
So, Rodrigo, you advise companies on ESG and impact investing. Let's dispel some myths. Is there a trade-off here between social impact investing and financial returns?
Not necessarily. Thank you very much for the invitation, FII. It's a pleasure being here. Well, for starters, we have to distinguish ESG from impact investing, ESG from impact. When two hungry people, same age, same size, they go to a supermarket, both are hungry, and they are going for grocery shopping, they are hungry and they want to prepare their meals for dinner, Some of them might buy ingredients for a pizza, the second one might buy ingredients for a moussaka or something else. So the supermarket is the global encompassing ESG world. And within the supermarket, within these metrics, these policies, these factors, some people might just look for information in order to apply it in an impactful way. Other people might consider the risk profile of those investments. Let me be more explicit. Impact investing, it's about investing in companies whose products and services generate positive social and environmental impact, and that impact needs to be measured. This accounts for $1.2 trillion. There are 1,289 organizations, 50% of them from North America. This is impact investing, and this amounts to around 1% of the global ESG world of this global supermarket. On the other hand, you have risk management. Risk management is when you go to the supermarket, you collect data, you collect policies, you collect factors, you collect characteristics from companies, and you integrate this information into your risk management tools, into your valuation tools, with the ultimate goal to identify risk with more precision. This other field, ESG integration, accounts for 99% of the global sustainable finance world. So impact investing is important. ESG, statistically, it's way more important. And ESG is gradually being weaved into traditional finance. So to your question, is that a trade-off? No, not necessarily. So over the last 10 years, there has been 1,500 studies, peer-reviewed academic articles, demonstrating there is a positive correlation between purpose and profit, a positive correlation between the more sustainable companies are, the better performance they would have. So you don't need to sacrifice returns, neither if you're doing ESG integration, nor if you're doing impact investing.
So Jenny, you've been in this field for a long time in ESG and impact investing. Your desire to tackle food insecurity has led to many investments in food tech and sustainability, for example. So we're supposed to achieve the UN Sustainable Development Goals by 2030, right around the corner. Should we be celebrating the $1 trillion that have already been made towards this impact investing, or when there are trillions more, $4 trillion to move to the SDGs?
Yeah, thank you, Lisa. I'm very happy to be here. So as Elise mentioned, I do wear many different hats. At GGV Capital, we've been a global venture capital firm investing in US, China, and Asia, some of the largest markets over the last 20 years. I also wear a different hat. I'm also on the board of Temasek, which is one of two sovereign wealth in Singapore as well, on the Risk and Sustainability Committee. And so I think my response is that it's great that there's a target. It's great that there's a time frame. And I think that the increased awareness across all the conferences, the discussion is definitely great, but a lot more needs to be done. And so I think whether it has, the Temasek hat or the GGV hat, our belief is that more needs to be done. And one of the key driver is really technology. We believe that, as we all saw as well, we're now in an extremely complex world, right? Whether it's macro politics, economic, geopolitics, and so, we have to come down to a common goal. And in our view, I think the common goal is, how do we use technology? How do we invest in the right technology and leveraging the power of capital to ensure that all of us sitting here, all of you sitting out there, every investment that we make actually has an impact. And so just to share, Temasek has a charter. It's actually built into the Temasek charter to always do well, do right, and do good. And they are actually, there's no front or it's essentially a balanced weight across all three initiatives, right? And so I do believe that we got to do, every time we think about investment, whether it's an early startup or later stage startup, that's a key consideration. And I just want to maybe highlight some examples, right? So in the US, we've invested in the early software company. The company is what they call providing software to help say, retail shop, the Starbucks of the world manage their inventory a lot better. So it's about data. It's about tracking the flow of cups of coffee that's being sold every day and being able to supply the amount of coffee beans and cakes and all that goes to the retail, right? Just the fact that they use data to capture all this information along the way means that they can reduce waste on a daily basis, right? So is this a software company? Has this software company done good? At the end of the year, it's highly measurable because you can track the number of coffee that's being sold, the number of pieces of cakes that's being sold, versus the excess wastage that's going to come from just over-ordering on a daily basis, right? So I think one is definitely a great company. It's helping to digitize and make more efficient the supply chain. On the other hand, the actual data that's being produced as part of this is extremely measurable, and you can tell particular Starbucks store that you can do better. It's one example.
Yeah, and I want to go
front.
a little bit more into the metrics in a bit, but I mean, I think what we're taking from this is, clearly public funds are not going to be enough, and it's about mobilizing. It's not just about going to conferences and talking about it, but it's about mobilizing that private capital to, close the growing
Every
gap on the
single investment.
Yeah, yeah. So Brian, let's go to you. You're one of the architects of the Abraham Accords, which we've been talking a lot about in the at FII this week. How has that enhanced cross-border investment in the region? And let's talk a little bit about the potential for impact, not just here in the region, but around the world.
Thanks, Elise. I've been coming to the region for over 15 years. What we're seeing here is nothing short of like an economic, cultural, and social transformation in Saudi Arabia and in the Gulf broadly. I think this is one of the most economically dynamic regions in the world today, and that is going to continue. You see increased people-to-people ties, greater privatization in a number of Gulf economies. The Abraham Accords, which you mentioned, has unlocked investment opportunities that we have been hoping for I think, some time. In 2021, you had $2 billion in trade between Abraham Accord countries. In UAE and Israel, it's a 163% increase in trade since August of 2 years ago. And so we recently celebrated the 2-year anniversary of the Abraham Accords. The economic benefits have been significant, and that's going to continue for companies and for firms that want to make an impact, that care about a lot of the themes that have been discussed here over the last week. I think this is the region where you're going to make the biggest impact, where there's the greatest opportunity. The leadership in the Gulf is transformative. And it's a very exciting time to be a part of it. As I said, having come here for 15 years, it's profound change, economically, culturally. But it's the people-to-people ties that I think are going to keep expanding, and that's going to create new opportunities for investment and for growth and for impact.
Yeah, and when you talk about the impact here in the region, I mean, that's what FII is all about. It's not a conference where we go and we're whining about the problems. It's here's the problem, here's the potential solution, here's the project that has the potential for impact, and let's go. So those are the conversations that are taking place here this week. Jacques-Philippe, as the global economy grows more volatile, aid budgets are being stressed, the SDGs, financing them are becoming a little bit more challenging. And, there's a lot of talk this week by business leaders about the upcoming recession. How likely do you think that is to disrupt impact investing from a purely financial perspective when the human need for social entrepreneurship and the finance behind it is only going to rise exponentially? How is impact investing going to meet that challenge?
Sure, Elise, I think that's an excellent question. And I plus one what has been said on this panel so far. And, one of the things that we talked about earlier around that $3 trillion gap between what's being spent on impact investing and what's said to be necessary for the UN SDGs, 18 months ago, I moderated a conversation with Sir Ronald Cohen after he had just written a book called Impact, and it was called the $40 trillion gap between impact and ESG investing. And the idea is that in the previous year, about 40 trillion had actually poured into ESG, and less than $1 trillion had gone into impact. And that represents a massive opportunity, especially as you have a new generation that's coming into wealth that is really keen on impact. And the way that Sir Ronald Cohen defines impact is that it's measurable, right? So people put money into ESG strategies because they're thinking that they're having impact, but oftentimes it's not measured and it's not actually clear. And so I believe capital, LPs, investors are actually going to drive that shift. And so that $3 trillion gap that the UN is talking about is not actually that big relative to the amount that's already being spent on ESG. So I believe that in the next 5 years, you'll have more than $4 trillion going to impact type investing because it's just going to be driven by the investors. Now, to your specific question with respect to the opportunities and how ESG or impact investing is going to be hit given the downturn in the economy, I think what's been said earlier is something that everyone should focus on. It's the idea that impact investing is somehow concessionary. It actually is not. It correlates highly with performance. And one of the things that has not been brought up yet is the benefit of diversity, equity, and inclusion, right? So McKinsey did a report not too long ago, and it showed that having a more diverse board, diverse leadership actually leads to something like 30% higher revenues for large corporations. BCG did a study on gender equity, gender performance. $1 provided to female founders or co-founders leads to about 78 cents of revenues, whereas that same dollar for all male founders, it's less than half of that in revenues. And then when you look at where the money's actually going, less than 6%, at least for the United States, and Europe is similar, less than 6% of the capital in venture investing is going to that entire demographic. So as an investor, it's about finding opportunity, and if one believes that talent and expertise are broadly distributed, it's a no-brainer. There's so much more opportunity there. And so for us, that's why at Goodlight, that's part of our thesis, right? We're specifically targeting amazing founders that are solving for challenges that are relevant in the world. And in the last couple of years, we've just seen that this is something that leads to outperformance on a relative basis. And whereas historically I've been in the industry for a long time, AIG Investments, Pinebridge Investments, lots of different large platforms. There was a time where people saw investments as a kind of zero-sum game, whereas we're in a place now where I believe everyone needs to come in. So the more folks are participating in impact investing, the better it is for all of us. And I'll stop there.
So Rodrigo, when you're talking to your clients, and we're headed towards an economic downturn, how do you kind of tell them to stay the course? Like what you're telling them in terms of the financial climate? How do you tell them to stay the course when financial gain may take precedence for a while over social impact? We talk, again, you said there's not a trade-off, but if we're heading towards a recession, does one of them have to give?
Well, there is a recession, there is ESG backlash. So we get a lot of questions from our financial clients in different countries on the future of ESG, whether they should be allocating resources through ESG lenses, whether this is a reliable field or not. And most of us here in this plenary are asking exactly the same questions. Shall I bet on this? Does it make sense? Is it something that I should pursue or not? And when we get those questions, and a lot of them are asking us, there's a lot of debate, political debate around ESG in the United States, a lot of criticism. Shall I press the pause button and let things be quiet for a while before I re-engage with ESG? So our answer to all these questions is no, don't do it. So let's go first to the United States. ESG was caught in a shooting between Democrats and Republicans ahead of the November elections. It started off in May when former Vice President Pence decided to criticize environmental activists for persuading ExxonMobil to make renewable investments. Later, it was picked up by DeSantis in Florida, and it was picked up as well by Abbott in Texas, Governor Abbott in Texas. And just a few weeks ago, the governors of Louisiana and the governors of Missouri decided to pull out $1.3 billion from BlackRock because BlackRock was doing moral investing.
We saw this letter, right, to Larry Fink, the CEO, by 19 Republican states saying that he's pursuing environmental ESG policies to the detriment of their state pensions.
That is very right. But on the other hand, you had the Democrats and the pension funds, state-controlled by Democrat-led governments, counterattacking. For example, in New York, the pension fund sent a letter to Larry Fink saying, Larry, if you don't step up your game on climate change, we will withdraw our resources from BlackRock. So it's clearly a political game. It's noise. It's a cacophony. It will fade away very quickly. So I would recommend everyone not to pay that much attention to it. It will be akin to, shall biodiversity be criminalized in Brazil? Just because we're going to have elections in 3 days and one of the contenders is a climate change denier and is favoring deforestation of the Amazon? Obviously not. So it should be framed in a very political way, and it's going to fade away very quickly. But the important point is there is no good investments without integrating ESG. It's irresponsible, it's unsophisticated, it's unprofessional. ESG is a set of characteristics emanating from the financial asset that investors need to incorporate into their traditional investment making to allocate resources. Not doing that will be a violation of their fiduciary duties. So ESG, it's not necessarily about saving the planet or doing good. That is mostly impact investing, which is noble, it's gentle, it's important, it's fulsome, it's interesting. But an investor on late October 2022 in whatever part of the world, including this kingdom, a traditional investor could be a $5 million family office, it could be $1 trillion sovereign wealth fund. An investor, as we speak, that does not integrate ESG policies, metrics, factors into their risk policies, into their asset management, with the intention to leverage and maximize their profits, with the intention to identify with more precision the risk profile of those assets, quite frankly, it's not a highly sophisticated investor.
And Jenny, we were talking before the session about how you think that ESG investing and impact investing should be in every fund.
Yeah, so I always feel that for us to embark on a common goal, there are many different tactical ways to do it. It starts with one, setting the goal, but more importantly, it's increasing the awareness. So I wouldn't go that far into saying that if you don't incorporate ESG policies into your investment, if you have a family office, and it's not incorporated yet, that you're not sophisticated. I do feel that we're trying to do this globally together. And so the most important thing is going from 0 to 1 in terms of awareness. And so that awareness has to be alleviated and maybe represented by different stakeholders, right? I think the government in many, many countries has the task of setting the right goal, right? In Singapore, for example, we have a green plan, which is really by 2030 to have all newly registered automotive or cars to be green energy. They have put in specific targets to plant, like 1 million trees to make sure that 20% of all schools are actually sustainable. So I think governments needs to do that. On the other hand, on food, Singapore again declared that by 2030 they want to get to 30% self-sufficient protein provision. In the next 8 years. So I think that for government, you do have a role of setting the guidepost, setting the target, setting the time frame. but not be overly stringent in terms of telling people how to go from 0 to 1 to 2 to 3. So once awareness is set, I think the other stakeholders will be the capital allocators, the investors, the family offices, to say that, that has to be kind of top of mind, right? And I think it takes a long time to change the world, right? And this is one that's, again, on a global basis. And I would hesitate to say, oh, you are not sophisticated or you are sophisticated, because at the end of the day, how do you define sophistication? Is it because they made money or do they not make money? Right? So I also want to then make this real into the startup world. As a CEO, as an entrepreneur, when you're trying to change the world and you say, I just want to build this great product that's going to, for example, I give an example, education inclusion. We have a company in China that was using AI technology to allow learning to be mechanized on a mobile phone, so that they can, they can actually allow this learning to go out across all the population, regardless of city. As you know, China is highly penetrated in terms of mobile phone access. For those who can afford it in tier 1, tier 2 cities, you pay a little bit, as you download and use the app. The company went as far as actually leveraging the same technology, the same product, and providing it free to the villages out in the mountains that has no teachers, because you couldn't get teachers to go to those villages. Right, so now for a company like that, they first have to do product market fit. They have to make sure that tech is working, that it's great, curriculum is good. Obviously, there has to be a paying customer, because then the paying customer is helping to continue the R&D effort. But because there's awareness within the company management team to also want to do, to make sure that the average person can get access, they actually provide it then free to the rest of the population. So that's why I think the awareness needs to go in, and to the extent, if you do well, great product, you do the right thing, and what's the right thing is making sure that you price this accessibility the right way. And then the company would do well, right? Because then you get the support. So that's is the step that I would go through.
Ryan, pick up on that. She talks about awareness and kind of the sophistication of investors. For some that didn't traditionally come to market with a whole, ESG or impact, mindset, it's a whole new paradigm. Whereas, these type of investments years ago, before it became a thing, were more of a philanthropic type of thing, or a PR type of thing. And now it's about, measuring impact in addition to financial return.
We are seeing a new paradigm in the United States, as you pointed out earlier. It has become a divisive issue. I think you had pointed that out. We have almost half of the states in the United States have expressed concern through their Attorney General about ESG policies. I think characterizing that as noise is not productive. I think if somebody disagrees with you, it isn't fair for debate to characterize it as noise. And I think when we do that, we increase the polarization in the United States. Just because somebody disagrees with you, it shouldn't be dismissed as noise or political. Debate is healthy. It's healthy for ESG to have the debate. And so that debate is going to continue. We ought to encourage it. If we try to silence the other side, it's bad for debate. And so as a process matter, I think we ought to be spending more time listening to each other than demonizing each other. I think we talked a little bit earlier about some of the macro headwinds that the global economy is going to be facing, is currently facing. What effect will that have on things like ESG? I think here in the Gulf, there's been a real focus on new partnerships, new alliances, on sustainability. Regardless of the sort of economic downturn that I think we're going to be looking at around the corner, that's going to continue. There is a great focus on sustainability and on renewable energies and resource conservation. As I said earlier, greater people-to-people ties. All of that's going to continue because I think there is a new paradigm that we ought to encourage. At the same time, I think we ought to be having a very healthy debate about these policies, which we are having in the United States. It's a good thing. It's not a bad thing.
Rodrigo, you want to quickly respond to that?
I want to think about the future. I don't want to think about the 2022.
Yeah.
So how do I look at ESG and impact in the coming 2 or 3 years? I think we are in the ESG 1.0 version.
Good point.
So ESG 1.0, we are facing numerous difficulties. One of them in the United States, and I agree with you. So ESG 1.0 is characterized by lack of standardization. No one knows exactly what an ESG fund should look like. If you are in Kazakhstan, New York, or in the Kingdom, the way you define an ESG fund varies. There are way many ESG rating agencies, over 100 of them. The legal setting of ESG needs to be more consolidated. The terminology is inconsistent. So the whole infrastructure around ESG, and partially the infrastructure around the impact, it needs to be improved. ESG 2.0, we are moving from 30 reporting frameworks to 1. We are moving from 100 ESG rating agencies to 3 or 4, and a process led by Brazil and by the UK. We are moving towards fund standardization that is coming along very, very, very quickly. So ESG will be more precise, scientific, mathematical, simple, coherent. That's ESG 2.0. ESG 3.0, Elise, I'm so passionate about ESG that I believe the future of ESG is non-ESG. So ESG will be so incorporated, so weaved in traditional finance that we're going to stop talking about it. A good analogy is the social quotas. It makes sense to have social quotas, temporary social instruments to carve out portions of society in order to find the right balances. We have been able to carve out ESG as a subset of important fundamental metrics, and very soon those subset of metrics are going to fade away. ESG will be absolutely banalized, normalized, and become mainstream.
Okay, that went so fast. We have so much more to discuss on this. We have about 30 seconds left. Jenny, say a quick word about metrics. What's the key thing we need to know?
For measurement?
Measurements.
Yeah, so maybe the limited, I do feel that I agree. I think ESG is in level 1.0. To have, so what's very important to progress to 2.0, 3.0, to incorporate thought processes and measurement, we do need to have what we call an ESG operating system, right?
Yeah,
Much as all of us
framework.
are using iPhones, Apple operating system, or Android operating system, I think the stakeholders needs to come together and do define one set of operating system that can be replicated and recognized and shared and cooperated across the world.
Okay, Jacques-Philippe, the last word to you. Quickly, some of the areas that are showing the high growth, people in this room, what they need to know about where impact investing can have both the most impact and financial return, you think?
Health, climate, education, future employment, things that are important in the world. And for the rest of my 30 seconds, I want to add to the future. 2000 was the Millennium Development Goals. 2015, Sustainable Development Goals. Sooner rather than later, it's going to be regenerative development goals. Sustainable development goals keep us where we are, and we're at a point where more needs to be done in order for us to actually save ourselves. And I think that's also going to correlate with outperformance, and I'd like to leave you with that. Regenerative is part of the future. Okay, people, we have about $4.2 trillion more for impact investing. It can start today. Thank you very much to our panel, and thank you to FII for a wonderful week. Wonderful.